Good afternoon, folks. Gonna let folks trickle in, get things set up. I see that Jake is here. Let me invite him to co-host. Gonna set some ground rules, read a couple disclaimers, and get us underway in a minute or two here. Yep, I see we've got Jake up as co-host. So for now, before we open it up to audience Q&A, I'm going to leave just Jake and myself as co-hosts. After we get through a little bit of the Q&A, folks are welcome to request, and if there are any questions they have, of course, please try to keep it civil and try to keep it within the realm of things that he can answer. We're going to let Jake do an intro, but before I do that, I just need to read my own disclaimer. So while I'm hosting this in my own personal capacity, I do just want to kind of read a disclaimer given my professional capacity. Just need you all to be aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay. So I'll set a little bit of background before I let Jake intro himself, and then we dive in. Thanks again, everybody, for joining. I have been following Bed Bath & Beyond myself from a distance for some time now. I've hosted a couple prior discussions on Bed Bath, the Wook End product that Wook Capital has begun. We had a bit of a discussion about shareholder activism as it pertained to Bed Bath Beyond. Obviously, Freeman Capital is a 13G filer, and they are passive. And Jake will, point out that he's. I'll let him speak to that. But there's been shareholder activism in Bed Bath Beyond for years now. 2019, there was a successful campaign. Earlier this year, there was a successful campaign from RC Ventures, Ryan Cohen's investment vehicle. So this ticker's had a significant amount of activism of late. It's obviously considered in the market by some as a meme stock, for whatever that means. It's been a very volatile security, and it's been facing headwinds that many physical retail players are facing as it's embarked on a transformation plan from its previous CEO, who is no longer with the company as of this most recent earnings. So it's a bit of a tumultuous environment for the security. There's been a lot going on, and recently, 8 days ago, I know that Freeman Capital filed a Form 13G and also a proposed plan pertaining to a path forward given the company's debt situation in order to ideally, I think, and I'll let Jake put it in his own words, but I think the goal is to see a positive outcome for both equity and for creditors. And look, I'm not by any stretch a credit expert. This is actually space I'm very personally experienced in. So if there are folks on who are credit experts, you are by all means the folks that I hope to hear, good informed questions by when we get to the Q&A. But with that, Jake, please go right ahead and introduce yourself before we get underway.
Yeah, thank you, Rod. So I'm representing FCM BUI Holdings LLC and Freeman Capital Management LLC in the capacity as their sole managers. Like Rod, I'm going to begin with disclaimers. So the meeting and interview is for informational purposes only. You should not construe any information or other material as legal, tax, investment, financial, or other advice. Nothing contained in this meeting constitutes a solicitation, recommendation, or endorsement or offer by FCM BUI Holdings LLC or any affiliate to buy or sell any security or other financial instruments in this or in any other jurisdiction in which the solicitation or offer would be unlawful under the securities law in that jurisdiction. All communications during this meeting is information of a general nature and does not address the circumstances of any particular individual. Nothing in this address or comments constitutes professional and or financial advice, nor does any information addressed by FCM BUI Holdings LLC or any affiliate thereof constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. Neither FCM BUI Holdings LLC nor its affiliates is a fiduciary by virtue of any person's use or access to the comments provided here. You alone assume sole responsibility of evaluating the merits and risks associated with the use of any information before making any decisions based on any information or other content provided here. By listening or commenting on this event, you agreed not to hold FCMBUI Holdings LLC, its affiliates, or third-party service providers liable for any possible claim from damages arising from your decision to make an investment based on the information or other material made available to you through this interview. There are risks associated with investing in securities, investing in stocks, bonds, exchange-traded funds, mutual funds, and other money market funds, and they involve risk of loss of principal as possible. High-risk investments may use leverage, which may accentuate gains and losses. Foreign investing involves special risks, including greater volatility and political, economic, and currency risks, and differences in the accounting method. A security firm's past performance is not a guarantee or predictor of their future performance. So now kind of addressing more on a direct note as it relates to Bed Bath & Beyond. In accordance with 17 CFR section 240.13D-1, this interview doesn't create a group with any individual with respect to Bed Bath & Beyond Incorporated. Any statement involving Bed Bath & Beyond Incorporated, Jake Freeman is solely and wholly representing the views as FCM BUI Holdings LLC, exclusively in its capacity as its sole manager. For kind of the purpose of our discussion, FCM BUI Holdings LLC may be referred to as FCM, I, or we. This meeting is not a solicitation of any security and should not be viewed in any manner as an attempt to induce you into buying any security. Furthermore, this meeting is not intended to influence the market price of Bed Bath & Beyond Incorporated. Under the passive investor stuff, just to clarify, this is mostly to clarify questions and misconceptions investors have with respect to the letter. We do not intend for any of the comments to change or influence control of Bed Bath & Beyond Incorporated, nor should we regard it as solicitation of votes now and in the future for our proposed plan. Jake, we will not comment on management nor any large activist shareholder in order to maintain compliance with the applicable SEC rules. FCM BUI Holdings LLC will only disclose it as a beneficial ownership of 6.21% of Bed Bath & Beyond and will not address any questions relating to its acquisition. So basically focusing kind of on the plan at a high level, it can kind of be broken down into two parts, reducing existing debt and issuing new debt. The reducing existing debt is simply for the senior unsecured notes to trade up to higher security notes in exchange. They reduce kind of the amount of money owed and also the interest costs towards BBY. By itself, this does help debt holders and also does not adversely affect the equity holders as they're still behind the debt holders. To help incentivize the bondholders, warrants will be issued, and I will remark further on the warrants as many people have had comments on them. The second phase of the proposal is issuing these 2028 notes. They're secured on liens of various BBY assets, including $350 million in Bye Bye Baby holdings. Investors will want to, basically the idea here is that investors purchase the bond if they believe that they will make money in excess of kind of their risk. So the convertibility, which again is something that people have had a lot of comments on and will be addressed later, kind of the fair market value of $412, but with some dilutive effects, it probably will be around $300, not just reflecting liquidity. Essentially, that's just money that the bondholders will receive up front and helps reduce the effective interest rate of Bed Bath & Beyond notes from around 11% to 5%, which saves Bed Bath & Beyond around $60 million a year. They are collateralized on a first lien basis on Bye Bye Baby up to the $350 million discussed. This means that bondholders receive the first $350 million in the event of a sale of Bye Bye Baby. It doesn't impede or inhibit the ability for them to do a sale or spinoff. Wedbush valued Bye Bye Baby at least $900 million. Essentially, you can put a valuation based off of FCM's valuation, it would be in excess of the $350 million valuation. That's primarily and exclusively for the purposes of whether or not bondholders will receive a recovery. Essentially, the remaining balance sheet has, if you kind of strip the bye-bye baby portion out of it, just prorating based on revenue, you essentially have about a $677 million recovery expectation on the inventory. When you exclude leasehold improvements from the property and equipment and then include other cash and intellectual properties, it would provide about another $600 million recovery. So it's likely that the bonds will receive a full or nearly full recovery in the event of bankruptcy. That's kind of the reason why people might buy the bonds. So I want to kind of address kind of the issues that people have regarding kind of the anti-equity portion of the plan. So right now it's kind of a bear market, which is generally a risk-off environment. So people need to be enticed to invest in new capital, especially $1 billion into Bed Bath & Beyond. So that's why bondholders need to be, basically for the bondholders who are converting their debt, Bed Bath & Beyond will kind of need to reach a $15 to $17 range. So even though the strike price is $8, they aren't really making money per se until it gets to the $15 to $17 range. The warrants and convertible portion of the bonds, if exercised in full, would result in another 240 million shares. For context, is approximately 80 million shares. However, these will not all be exercised at once, and given the time value portion of an option, they will tend to be exercised towards the end of their term, which would be in 2028, 2029, and 2032, which are obviously there's some room for things to happen in the interim there. The warrants would also, though, if they are converted, would provide $1 billion in capital to Bed Bath & Beyond, and the convertibility part of the bonds that have been proposed would it would basically take that $1 billion that was debt and now it's equity. So this provides effectively $2 billion to the company, which is approximately $6.12 per share on a diluted basis. So if basically the shares are trading at $8, assuming kind of the worst case scenario of the warrants, exclusively with respect to the warrants, kind of pushing the stock price down in that sense, there'd be an extra $6.12 in terms of just cash that would be available. Another sort of anti-equity comment in quotes people provided is the plan traps the value of Bye-Bye Baby. A lot has changed with respect to the underlying macroeconomic environment since a certain shareholder penned a letter to the board. The general market conditions are adverse towards M&A activities. And this plan taps into some of the value of Baby to provide Bed Bath & Beyond with liquidity to sell Baby at a later time frame when general market conditions are more favorable. It also allows the board to continue their strategic vision that they've announced regarding Bed Bath & Beyond's core stores. And additionally, it's the separation of Baby from Bye-Bye Baby from Bed Bath & Beyond would be a fairly costly endeavor, both in terms of reconfiguring the logistical side. And right now, Bed Bath & Beyond's limited liquidity hurts them in any negotiation for a sale because companies looking to acquire Baby know that Bed Bath & Beyond needs a liquidity injection in the near future. And sort of on one final note, several institutional analysts and some on Reddit have kind of asked why bondholders would take the debt exchange. So I'm going to quickly opine on that. If the second phase of the plan sort of succeeds, there would be a significant holdout problem with the 2024 issue. However, it would be ultimately moot as liquidity concerns will be overall solved. If the second part does succeed, given the increase in liens in the capital structure, the 2034 and 2044 notes would be highly incentivized to convert because a larger chance to get something is better than a negligible chance to be paid in full. And additionally, they receive warrants to help entice them to that. If the second part of the plan is unlikely to succeed, then it's likely that BBUI's liquidity position would not be advantageous to the 2024 notes, resulting in them converting and reducing the debt load. And the 2034 notes and 2044 notes would still switch for the same reason as above. I did do a game theoretic analysis on this, and it does perform favorably. That's kind of my prepared remarks. Yeah.
Awesome. Jake, there's a ton of information in there, really good stuff that some of it goes over my head. A lot of it goes over my head. I'm sure there's other listeners who aren't so familiar with the credit side of this, and it's gone over there. But I'll summarize my understanding of some of the things you said, and then I'll maybe ask a few clarifying questions and then welcome folks to ask their own questions. So I think you made a point that earlier this year, there was a proposal regarding baby and that market conditions have changed significantly for it's less favorable environment today than it was five whatever months ago to spin or sell or otherwise dispose of and realize a gain or other from the baby asset. You noted that because of those conditions, right? It's game theory. Creditors are aware, equity holders are aware, players are aware that the environment has deteriorated. Therefore, given the cash burn of the company over the previous 2 quarters and the situation it finds itself in, they are less likely to give the most favorable terms as a prospective buyer. And that you believe that, or FCM believes that its plan basically extends the runway for Bed Bath and Beyond by finding kind of a win-win for equity and for the creditors to allow the company more time for the marketplace to improve, to find a resolution to baby, whether it's a spin, sale, or other, and to successfully have the liquidity net of your proposal, FCM's proposal, to basically continue operating and not being faced with potentially a restructuring in a less favorable situation for equity. I hope I didn't miss anything or go off the rails there. Is that reasonable?
I would say it's a reasonable characterization, yes.
Okay, good. So look, Jake, I know that there were questions in the GMEDD Discord that you had hopped into. I'm going to just give some background information. As some folks may know, I co-founded GMEDD, which we consider ourselves basically a communication crowdsourced information platform that was set up originally around GameStop, but is really broadly around any equities that people want to have conversations around for retail-oriented shareholders to really just have those discussions. And we've been going strong. There's several thousand folks in the server. I think somebody in the server had, after the 13G filing, done some sleuthing and uncovered Jake's information, which led him to, I think, come onto social media and come into the server and offer to answer some questions around the plan. So that's kind of why I'm posting this. And just to be clear, for me personally, I have 30 cash secured puts for the $5 and $4 strikes for August and September. That's my only position in Bed Bath and Beyond personally. So I have it's like a 1% margin allocation for my portfolio. It's relatively small, and obviously it's writing short-term puts. So I'm not a Bed Bath and Beyond shareholder, but I am interested in giving retail investors access to information. And it was kind of Jake, I think, after speaking to institutional investors, come really searching to talk to retail investors, which he did on both Reddit and our BBBY and GMEDD. So this Q&A that is being recorded, and you're welcome to replay it for up to 30 days after we conclude today. I intend for us to wrap no later than 6 p.m. FYI, it's 4:19 p.m. Eastern right now. So I hope that everyone is able to ask questions to their satisfaction to the extent that Jake is able to answer them. Hopefully hearing his summary and that brief characterization I made gives you an idea of the thinking behind this. And yeah, with that, I'll pause and really let folks raise their hand, request to come up to speak and ask any incremental questions. I have my own to have some of, but I'd like to really keep it conversational and hope that different retail investors can get what they're looking for, answers pertaining to FCM's plan. So I'll wait and see if anybody comes on up before I don't jump into any of my questions. All right, not everybody all at once. Okay, while I wait to see if people get less shy, Let me ask, Jake, you talked about a game theoretical exercise, and you'd mentioned that the warrant analysis and logic was a quantitative analysis where the objective was to minimize dilution and maximize potential upside on equity. Obviously, FCM has the disclosed 13G position, and in the plan, which I pinned to the top, that's on file with the SEC, FCM disclosed a position in the 2024 bonds. For those who didn't review, I know FCM made comments on Reddit noting, and Jake, please correct me if I say anything wrong, but I believe FCM noted that it has, in addition to the equity and the 2024 bonds, it has call options and does not own any put options. Could you maybe talk a little bit about, not to go too wonky in the weeds on I guess the mathematical side? I think everyone it's followed the ticker. I alluded to my own personal position, has noted the very high volatility priced in the market on the ticker, given the wide range of outcomes. Could you maybe talk a little bit about that analysis that you concluded the 8 strike warrants was optimal?
Yeah, sure. To start off, I just want to clarify that, as discussed, I placed on the Reddit, FCM does in fact have call options on Bed Bath & Beyond, and FCM nor any of its affiliates currently have any put positions that are long or short. And then kind of jumping into the actual question, essentially, BBY has significantly high premiums on their call options. And essentially what that allows you to do is, if you're issuing these warrants, and essentially the warrants are kind of in lieu of a cash payment. And what happens is, if you have a high premium, it is less dilutive when you're issuing these warrants, because if you're trying to say, give $10 and your premium on these options is 1, then it would take 10 shares worth of warrants, versus if it was 5, it would take 2 shares. So that's kind of the overarching kind of idea. For the more quantitative side of this, essentially it's a balancing act between the higher the strike price you go, obviously results in a less cap on equity, while also resulting in more dilutive pressures. So essentially that's kind of the balance there, and essentially employing a stochastic framework, which I am aware that probably a lot of people would not be familiar with that term. Essentially employing a modeling scenario which models both the general market conditions as well as the individual equity value of BBY. It's not meant to necessarily, each path isn't necessarily meant to represent what's going to happen, but it should have a similar feel to it. I'm trying to use more common vernacular, but if anyone wants to reach out regarding the more mathematical side, that's perfectly fine. Essentially, when the market conditions are bad, BBY will not be able to sell baby for as high a price, and when the market conditions are good, it'll be able to sell for higher. So making certain assumptions regarding the distribution of when management will want to sell baby, as well as the underlying economic structure, also lets you model kind of how these warrants would behave with respect to both the equity side and the people who are holding the warrants. And you can essentially, using a certain metric, analyze that and figure out what kind of maximizes the variables or minimizes one and maximizes the other. So I think that's kind of a way in which I can kind of explain that. For the game theoretic one, it's actually not a super complicated scenario for those who have done game theory. Ultimately, the question becomes, if none of the bondholders convert to the new bonds, then they're all better off as a whole, because they're the same amount of money. So they're all better off as a whole if no one converts and they get higher interest. But if a few people convert, they are much better off, and people who don't convert end up being worse off. So essentially, you end up in the similar dynamics to the prisoner dilemma problem, where I don't want to say it's the worst scenario, but ultimately the scenario that's most beneficial for Bed Bath & Beyond does occur, and to sort of ensure there's no, let's say, bad taste in anyone's mouth, the warrants help with that and help kind of ensure debt holders have confidence in management and are willing to both negotiate for more bond issuance, as obviously liquidity is a concern there.
Awesome. Great explanation. I think I understood some of it, so hopefully others understood more of it, smarter folks listening than I. All right, I'm going to let Walter come up and ask, hopefully plan-specific questions, and then Johnny, I will add you next as a speaker. So Walter, you've been added. You may be on mute, but please go on ahead and ask away. Yep, can hear you.
Yeah, so I just had a question, probably like two parts. The first one is more so on why there would need to be such a large equity warrant option with the new bonds, since they already have collateral on the inventory and the receivables. Like, I'm just thinking that because they just did the credit facility back in 21, and if I was a bank in the credit facility, I definitely wouldn't want BVY to issue any secured debt in general. So it seems like just to convert the bond and to reduce the amount, BVY has to give up so much. So I guess for that question, it's like, why do you feel as if the warrant and the amount of the warrant would be necessary for them to raise whatever funds they might need? And then number two is just more on the sizing. I know the debt offering is two parts, but I think my main issue with BVY is not necessarily liquidity. I mean, that is a huge issue, but even more so, it's what would they do with the cash? Because clearly, over the past few years, they have not been good operators in general. And so it's like, assuming that this debt restructuring goes through, they can raise a few $100 million, $1 billion plus of capital. It's like, I mean, that would only go towards working capital needs, right? I mean, there is no other use for that much cash that I could think of. So, yeah, more so for one on the terms, and then number two, just on the sizing of the transaction. Thank you.
I certainly cannot speak to my thoughts on what they should do with it. That is a management decision, and I will not comment on what management should do, shouldn't do. I will, however, make the statement that if management thinks that they do not need as much liquidity, they could obviously reduce the size of the issue. It would be possible with a reduced size to potentially remove the convertible feature. And then I think the first part of your question that you're asking, and correct me if I'm misconstruing this, I think the first part of the question you're asking is kind of why not just use the ABL facility? And the ABL facility has kind of two issues in the short term. One is it only has approximately $400 million left. So that's obviously potential, and that's in liquidity that's available. Obviously, $1 billion would help bolster that liquidity position. Additionally, the ABL facility has a spring maturity on May 1, 2024. So essentially, if the company is not able to sufficiently turn around their balance sheet by that time, they will have to file for bankruptcy. And that's pretty much a guarantee if that does happen, just simply from the way the credit documents are written. So the ABL facility also has a lot of encumbering terms upon Bed Bath & Beyond, whereas sort of these notes do not have such encumbering terms, and they are backed by a similar collateral basis. So it's not as though new collateral is being stripped away. It's sort of old collateral is being reallocated.
Okay, great. Thank you so much.
Thanks, Walter. All right, I'm gonna just put people down to listener after I bring them up, and if they want to return, back to the bottom of the queue or come back up, please just raise your hand. But just want to be fair so that anyone and everyone who does want to get a chance to speak and ask questions is able to do so. Johnny, I'm going to add you now as speaker, and you are muted. And welcome.
Hello.
Yep,
Hi, Jake. Thank you so much for giving us your time. I have one question that I'm sure it's on a lot of people's minds. I'm wondering if you could comment on or have any thoughts about the high short percentage or high short float on Bed Bath & Beyond stock. Thank you.
I can't comment directly on the short interest on Bed Bath & Beyond stocks. As a more general comment, I will make that when you have quote unquote crowded trades where a lot of people are believing the same thing, there can be self-fulfilling prophecies with them, which could result in exacerbations of sort of negative or positive movements.
All right. Thank you so much.
And this is my loose understanding, so this is not FCM's viewpoint, but in this situation like this, you could also see folks acquiring the bonds and shorting the equity as a hedge. Not that I have any knowledge of any of that, and obviously it doesn't pertain to FCM's position, but just my own adjacent response.
I mean, I'll address that. I saw several people have commented on the fact that these bonds provide kind of a safety net, so to speak, towards people who may engage in short selling. It's just essentially these bonds have an option in them, and it would be no different from a market pricing perspective than if these people were just simply to buy the option. So it doesn't change anything from that standpoint. People who wish to engage in a short position can certainly purchase an option on Bed Bath & Beyond in the open market. These, if anything, would probably not be conducive towards that trade simply because of how long dated they are. Typically, that would incur a higher premium, which may be something that short sellers would not want to be as inclined to pay. So I guess that would kind of be some of the reasons why people may not engage in that trade. Obviously, I don't speak for everyone who's ever thought of making a trade on Bed Bath & Beyond, and there is certainly a possibility that some people would want to engage in that play.
Johnny, thank you. Hope that answers to the extent that.
Yeah, thank you so much for having me.
Awesome, thank you. All right, Dirt Evader, pulling you up, and then Ghost, I've got you next. Dirt Evader, just go ahead and unmute.
Hi, Rod. Hi, Jake.
Howdy.
Jake, tell me about Freeman Capital Management, and then tell me a little bit about yourself.
So I'm Freeman Capital Management was created recently, and as I guess mentioned to several people, this is sort of the maiden voyage of Freeman Capital Management. And I guess some about myself. I'm 20 years old. I've been interested in finance for 8 years. I've been working in finance for about 6 years. I've done a lot in the options and credit space, both on a personal side and for the firms which I have worked for. And this is sort of striking it out on my own, so to speak, with this play.
How old did you say you were?
20.
And you've been working in the financial space for 6 years, since you were 14?
Yeah. Yes, I started when I was 14.
What's your middle name? I'm from Wyoming, so I was just curious.
I'm not from Wyoming. That's just simply where Freeman Capital Management was incorporated.
What's your middle name, Jake?
Spencer. It is available on some of the documentation anyways. So.
Any idea why there would be a Jake Freeman LLC set up in the state of Wyoming?
Yes, that is a corporation in which I have set up as well.
So is your name really Jake Freeman?
Yes.
You know, in the state of Wyoming, you can set up LLCs to represent an entity. And an entity can be anything. A person, a business, anything you want it to be, Jake.
Is there a question in there?
Yeah, it's just a little suspicious that somebody comes in out of the blue after setting up Jake Freeman LLC in January of this year, sets up Freeman Capital Management in May of this year, and then sets up FCM BBY Holdings this month. And you have been nowhere on Reddit, nowhere on Twitter. You don't live in the state of Wyoming. So why in the hell are you setting up an LLC in Wyoming unless you need to hide something?
I will comment briefly. I am aware that there is, quote, anonymity in certain Wyoming laws. The reason for setting up in Wyoming, and this is not tax advice to any persons, is that from my perspective, the perspective of Jake Freeman LLC, the perspective of Freeman Capital Management and FCM BBY Holdings LLC, is simply that Wyoming offers certain tax benefits that are advantageous towards those entities. And that is the reason why it was chosen to be set up there.
So the only reason for restructuring with this debt would be to profit for whoever buys the bonds. We know BB or Bye Bye Baby's worth $2 billion. Brian Cohen said it himself to letter to the board of directors. Not $1 billion, $2 billion. That's based on future cash flows.
I'm not sure if you joined late, Dertivator, but FCM was discussing the view that the market has deteriorated since earlier this year, and M&A activity, I think folks have maybe monitored the private market, public market. I think everyone can maybe come to a consensus that today versus 6 months ago is not as favorable. And I do think, I won't speak for Jake, but having listened to what he had to say, it sounds like the view is this extends the runway and gives them the ability to have optionality to get the best outcome for Baby. But Jake, I don't know if you have any other response there.
Yeah, I'm not going to continue this line of questioning. I believe if it is possible, yeah.
All right.
Thanks, Dertivator. Wait, I got one more question.
All right. Ghost, you're up next. Dertivator, if you have another one, you're welcome to rejoin. Please be respectful and not accusatory in demeaning the guest. I certainly understand people are skeptical, of a 20-year-old who has extensive experience in the financial services industry. I know that I was able to glance at Jake's LinkedIn before he turned it private. I was quite impressed myself, and I never interacted with Jake until this week personally. So I can only go by what I saw on his LinkedIn, which I he's made private, and obviously people are interested in young folks who have been in the space for a while. So anyways, look, I just want people to be respectful and try to ask questions pertaining to the plan and try to minimize the ad hominems. So Ghost, I've added you as a speaker and I've got some other folks queued up. Please go right ahead.
How's it going, man? Yeah, I just got a few questions. One, what is your intentions with BBY? What would you like to see come out of them as a company? And also, did the CEO making a purchase influence your decision to buy?
I was not influenced by any purchases by management. As for the long-term beliefs of BBY, I believe in the board's strategic vision for Bed Bath & Beyond. I think that kind of concludes the comments which I can make.
No, not the CEO of your fund. I mean the CEO of BBY. He made a recent purchase, probably a week before you guys did.
Yeah, I was referring to that. We were not influenced by the purchase of any management of Bed Bath & Beyond.
Okay. Would you say that your fund aligns with the views of Ryan Cohen and what he would like to see come out of them, such as like the split of Bed Bath and Bye Bye Baby?
The views of SCM do not contradict any of the proposed plans of any major activist shareholder, nor the plans or currently being implemented plans of management.
Okay.
Ghost, thank you. Let me see here. I've got Alpha Hound. Let me bring you up, sir. And full disclosure, Alpha Hound, myself, and Joe Funicello were the co-founders of GMEDD. So I've known Alpha since ninth grade. Nice to have you up here, Alpha.
Cool. Can you hear me?
Yes, sir.
Awesome. Jake, thank you so much for taking the time, and wishing you tremendous success with FCM with this position as well as anything in the future. So again, thank you. I guess, do you have an opinion about what the business's runway looks like? Failing to raise capital or cash in some other way, just based on the current run rate. And I guess, not that I want to dive into your history, I'm just very curious who you were able to raise money for, if those are other buy-side investors, or if you could divulge a little bit about that.
So for the second part first, no, I cannot comment due to confidentiality clauses on any investors, past, current, and probably future. I will, however, address the first part. Liquidity is a serious issue, as I mentioned, that if they don't find a way to get more funding, they have a hard cutoff on May 1st of 2024. Insolvency, though, is a fairly high risk. Obviously, cash flows, a lot of their inventory is not easily liquidable or liquidatable, and they are obviously a lot of money tied up in inventory. I see that if they can't either renegotiate their ABL facility or sort of engage with some other way to raise funding, they could have a serious issue as soon as the beginning of 2023, and that would be assuming they tap their rest of their ABL facility. So I do foresee a significant issue. Management may have a different perspective, and they might know more than me on that issue, and if they do, that would be wonderful. And I certainly wouldn't want to contradict them if they do have a strategic plan that would work to fix this problem.
Awesome. Thank you. It's really impressive what you put together here. So thanks for that.
All righty. Thanks, Alpha. Let me bring up learning stuff. And after learning stuff, I don't have any other folks in queue, but please continue with the questions. I think that it's great Jake's doing this. When he came to me again, the intent here was he had spoken to institutional folks and analysts. And he just wanted to share what FCM's plan was in a little more detail to retail. And obviously there's folks who are both retail investors and other listening to this conversation, but please just keep the questions respectful and not to stuff that he can't answer. But otherwise, learning, please go ahead. Learning, you're on mute, by the way.
Hi, Jake. Hi, Rod. Thank you very much for your time. I have one question. I understand from Reddit that you will not sell your shares even if the plan is not approved. So you believe in bye baby success. I was wondering if you have a price target for this, and how do you see this success?
First, my exact comment on Reddit for the record was simply that FCM is not changing its positions or making any adjustments regarding whether or not the board does in fact agree with the plan, wants to implement it in some way, or decides that they do not need to implement it. I will not, however, comment on a specific price target at this time.
I understand. Okay, thank you very much.
All right, thank you. Learning stuff. Puff, I'm going to bring you up, and then Bortles, and then I'll circle back to Ghost and Alpha Hound. Puff, please go ahead. Puff, you're on mute.
Man, I always do that. Thanks, Rod. Thank you, Jake, for being here. I just have a really quick question. For newer investors, myself included, I have a younger daughter who has just started to get her feet wet. With the time length that you're looking at here, with it being so far away, I don't know if you can answer this without technically, do you see any difference in a long-term play like this? As for a newer investor, would you be more cautious yourself, or I don't know how to answer this or ask the question. I'm so sorry. Do you understand what I'm saying?
Sure. I think I can answer this to some degree. Not directly related to Bed Bath & Beyond anyway, or any time frames related to that. In general, I would say for newer investors, longer term plays do tend to be kind of the better way to think about them. That's certainly how I got in. And I think the reason, at least that I find it persuasive to look longer term when you're starting off, is that there's a lot of things in the market that can just happen that would not affect your thesis, but still the stock price may go down as a result of that. And thus, it's hard to measure your performance when you're not really as cognizant yet of all of the exogenous variables that kind of can be induced. So I would say looking longer term, kind of to start off and kind of looking, it gives you a more fundamentalist approach rather than, I guess, a more, you have to make less assumptions regarding long term or shorter term catalysts and headwinds. A classic example would be if you had picked off like a position right before COVID, if you would have a lot harder time and potentially be discouraged just simply because you couldn't predict a shorter term macroeconomic event.
Oh, yeah, perfect. That's wonderful. Thank you so much. That's exactly what I was wanting to know. So I appreciate that. Thank you so much, Rod.
Thanks, Puff. All righty. Good stuff. All right. Bortles, come on up. Then I'll go to Ghost, and then I've got Alpha. I'll get back to you, but I want to get to the first time ask questions first, so I'll circle back to you, Alpha, and Bortles. Please go right ahead.
Mine's kind of a two-part question. Are you a customer of Bed Bath & Beyond? Do you shop there? Do you see any at the store level changes you were interested in implementing? And what do you see as far as the macroeconomic impacts on consumer discretionary spending?
Sure. So to answer the first thing is, I do in fact shop at Bed Bath & Beyond. One of my more common things to shop there is canisters of CO2 for, I guess, fizzy water or sparkling water. I am a fan of sparkling water. So I do shop there, and especially during times in which involve college and moving between apartments. With respect to that, I do shop there. And I would like to address kind of the consumer discretionary. I do see some headwinds in the consumer discretionary space, especially over the shorter term. I do, however, see that people are still getting a lot of basic items. People are not going to stop going to college, for example, and that's a classic example of somewhere where the omni-channel of Bed Bath & Beyond really does shine. I think overall the consumer discretionary space will face some pullback, but I do not think it will be as large as a lot of the other spaces. And I think that there's a lot of things that Bed Bath & Beyond offer that people are, I guess, more price indifferent to and are not willing to cut out of their lifestyle.
Thank you. Appreciate it.
Bortles, only because I looked at it yesterday, and it's, I think, a little relevant to the question about discretionary. I'd seen a note. The note was out a week ago from KeyBank Capital Markets. It had Placer.ai data, and it was showing both year over year and compared to 2019. Placer.ai kind of provides geo data from cell phones, anonymized activity. But from what I saw reported in that note, Bed Bath & Beyond's foot traffic was at the bottom of all of the retail basket. It was down meaningfully for both the 1 year and the 3 year. But again, that's Placer.ai data that I saw in a KeyBank note. So just wanted to share that. Okay, Bortles, thank you. Let me bring up Ghost, and then let me get to some of the other folks that are trying to come on up. Ghost, you're up.
Hey man, sorry, I just had one more question. As far as I know, you guys built a large shares position, but from reading through some of the Reddit comments, I'm aware that you guys also are holding options. I was curious what the strikes and expiration were for those options.
As I mentioned earlier, I will not comment on that, except as just what was disclosed in the 13G as it respects to any securities owned by FCM on Bed Bath & Beyond.
Wouldn't this be public though?
Under 13G, you are not required to disclose the exact composition of any securities in which you own. A 13D filing would, however, require that.
Gotcha. Okay, thank you.
All right, thank you. Iowa Hawkeyes, you're up, and then let me get to Brain Dump, Adam, and Oh Wow, and Alpha. I see you. I will get back to you. Hey, Iowa, we can hear you.
Yeah, I was wondering, with Ryan Cohen being involved in buying $80 call options, my question is, if the intention is for Bed Bath & Beyond to create a massive short squeeze, as they did in GameStop, why would it be in Bed Bath & Beyond's best interest to accept what you're discussing here with the bonds? Why would it be in their best interest versus attempting to sell Bye Bye Baby and creating that squeeze and essentially at a much higher price, hopefully having Bed Bath & Beyond turn around and essentially sell shares at a higher price, bring them public, and reduce their debt in that manner? I mean, if we're talking $80 call options, I mean, your prices that you're referring to right now that are strike prices in the teens, wouldn't they be better off trying that method first before even considering what you're referring to?
I'm not trying to comment that Bed Bath & Beyond would consider a short squeeze. That would probably be a legal gray area for a publicly traded company to attempt to try one of those. I would say that if they truly had conviction that that could happen, then it potentially would not be in their best interest. However, as people can note, you can't just if everyone knew that was going to happen, then I would agree. However, they are having a liquidity crunch, and obviously, there is a huge bear market right now, and it might not be possible to really get enough people to kind of initiate what you are proposing. I'm not saying that it could even happen. I think there's a lot of risk in a corporate strategy depending on the individual stock price and the hope, per se, that the stock price reaches what would be essentially a 13x position in less than 5 or 6 months. Certainly it could happen. However, I don't think it's prudent to necessarily consider that. However, I have given it some thought regarding the warrants, and it might be potentially available to Bed Bath & Beyond to structure the warrants in such a way that sort of over the short term, the warrants kind of would adjust their strike price. There are certainly various financial engineering situations that could be used to sort of achieve the same objective of the plan, however, adjust for the potential that you are mentioning regarding a large movement to the upside on Bed Bath & Beyond. Again, that would depend on what management's plans are.
Okay, thank you.
So I had a pretty deft answer there, Jake. All right, let me bring on up Brain Dump. You're up next, Adam, then Oh Wow. I'll get to you guys next. Yep, you're up.
Oh, okay.
I hear you.
Is it my turn? Okay, sorry. Thanks, Freeman, for doing this call and for screwing over my covered calls a couple of weeks ago. But I was wondering, what is your history with Valaris and the studies you were doing over bonds and hedging or slippage? Just how did you get started on those studies, and how did you end up working with Valaris on those studies?
I'm not going to comment on my direct affiliate or former affiliations with any firms, just simply to avoid dragging them into this, broader discussion. I will, however, comment that I don't think there's any published papers regarding slippage that I have published. I have definitely done work in this space. I think a lot of the research there is driven by both my own and the constituent firms that I worked for, desire to understand different mathematical phenomenon within the market and attempt to quantify it. And essentially, the goal for a lot of the research that I have done has been really to learn more about various aspects of math. For example, a lot of the papers have focused more on stochastic conditioning, as well as one of the published papers that you alluded to of the option hedging and risk neutrality. It was really about multi-state modeling and sort of the effects that has. I think the paper does have some really interesting conclusions, and I really do encourage people to read it. But yeah, I'd say that is kind of how that intersects.
Thank you. So you were not an author on that, but you were just kind of a assistant?
On all papers in which I was author, I completely was an author on.
Jesus. Dude, you're doing fucking amazing for 20-year-old, and like, that's insane. Good for you, man.
Thank you.
All right. Good stuff. I read one of those papers, or I tried reading one of those papers last night. It's very interesting. Definitely some of it went over my head, but just the concept that, what is taught in textbooks about how normal distributions work, and that there's a difference in reality from maybe what's taught in theory. There's some interesting stuff in there that, like I said, went over my head, but I found it interesting. Anyways, good stuff, brain dump. Let me bring on up Adam. And then Wow, Labistro, and I'll get back to the folks who've already gone once. Adam, you're up.
I just wanted to thank you guys for having me on. Do you guys Freeman Capital, do you guys have any like downfalls you see to your plan? Like in a way that this would impact, the company overall, or cause stock prices to drop more dramatically? Like I started investing in Bed Bath & Beyond in the 20s, and I still buy their shares to this day. Obviously down quite a bit from the drop, but the market's down in general. Just as like a shareholder, you know what I mean? Is there any kind of impact this would have long term?
Sure. So first off, I can't address your individual economics of your trades or anything with respect to Bed Bath & Beyond. What I will say is that this is a trade-off. Bed Bath & Beyond gets more assurances that, it's not going to have any liquidity issues, and it will be kind of have some runway to execute upon a strategic vision. But it does come at the cost where you have more potential for dilution, and that is certainly an issue. But essentially, given the kind of risk-off scenario that society or the market kind of has right now, it is hard to raise money through just simple debt, and there is obviously a limit to the amount of collateral Bed Bath & Beyond has, which ultimately results in using equity of some sort to help finance. Effectively, the question really should be for shareholders is there a more efficient or effective way to use equity to help raise monies? And obviously, that's something that management will also have to determine. And if management figures that there's a better way to do it, that would be ideal. I want to go against them on that. I think, though, it just basically comes down to the fact that the only real way to raise money right now, and I think the lack of debt issuance on Bed Bath & Beyond's part in the past few years has really reflected the fact that it's hard to issue debt, and I think that really leaves equity financing as sort of the main driver.
I gotcha.
And it's in Freeman Capital's letter, but just to note, the market values or the market prices of the bonds as of July 20th, they were severely discounted. The 24 notes traded around 40 cents on the dollar. FCM asserts that the market value reflects a 25% chance that the notes are paid off in full. So clearly the market sees significant risk with the current pricing on the credit positions. So I just wanted to point that part out as well.
And I appreciate that. And Rod and Jake, I appreciate both of your guys, what you do, and keep up the good work. And Thanks for taking the time to answer my question.
Thanks,
No problem.
Okie dokie. We've got, oh, wow. I'm adding you. Just unmute. Go right ahead. You're up.
Hey, Jake, thanks for taking the time to do this. You as well, Rod. My question is, and this might have been covered, so I apologize if it was, but what motivated you to engage retail investors, and how do you stand to benefit from engaging retail investors so directly?
Sure. So the first and one of the primary things is I feel that, institutional investors have, high level of access both to management and to people like myself, in which I have availed myself to various institutional investors, analysts, etc. And I wish to provide a similar availability to retail investors. And the other way is, it's for a lot of activism, and this isn't obviously going to be Freeman Capital's only play. So basically, in the future, coming down the pipe, there is a activist play on a different company, which I'm not going to disclose. But essentially, that company does have a Reddit community, and I think it's important to be able to engage with retail shareholders, and at least they don't necessarily agree with the plans in which I may have, but I would hope that I would like the ability to kind of talk them through it like we're doing now. Obviously, this is not necessarily an activist call, and I obviously do not want to solicit anyone's votes, but for other plays, it may be where I'm more trying to encourage sort of the retail investors who don't generally vote at meetings to vote in a way which would better them, at least as I understand it. The other play that I have in mind is a pure equity play, so obviously incentives would be more aligned on that one, rather than or not more aligned, but aligned on that one.
Got it. Thanks.
Awesome. Thanks. Oh, wow. And let me get to La Bistro. You're up. La Bistro, just unmute, and you're welcome to go ahead.
Oh, is it on now? Oh,
Yeah.
sorry about that. Hey, thanks for doing this, guys. I really appreciate it. I just have a couple of quick questions, if you don't mind. I believe it was on Reddit. You did respond and say that Freeman does own bonds right now. Was that right?
It was disclosed in the 13G filing in the letter. It did mention that FCM does own, through its affiliates, 2024 bonds.
Are you able to tell us when you acquired those originally?
I'm not going to comment on that right now.
Okay, I understand. That's fine.
But I will make a little bit of a comment on it.
Thanks.
They were acquired after a certain large activist shareholder announced his intentions.
Thank you. Next question, and I don't want to grill you like that first guy did on your CV and your resume. That wasn't cool. But you mentioned that you started working in the space at 14. When you say working in the space at 14, were you were studying, or you were actually working for a firm? Or I know you're not going to give the name or anything like that, which I understand. But can you just tell us a little bit more about what your experience was in the past 6 years?
Sure, I can address kind of, I guess, what my first project was in
cool.
In the finance space. My first project was looking at essentially taking various basic strategies, such as a 80% strike put on a large based index, unrolling it to essentially see how that performs as a tail risk hedge type idea, and then delta hedging that position over time in order to see kind of what's kind of the cost of tail risk hedging on a basic retail portfolio, and then ultimately testing various proprietary strategies for tail risk hedge using a similar backtest method that I had designed and made.
Okay. And this was all recent, or this is at the beginning of your career?
That was at the beginning. That was the first project I did.
That was the very first one. Wow. Okay. Last question. I don't know if you'll answer or not. Freeman Capital, obviously, it's a new company, which is fine. But can you give us a little more insight to where the capital came from? Is this your personal capital? Is it family money? At 20 years old, I wish I had 25 million, man. I mean, that's pretty impressive.
No, I'm sorry. It's not. It's not for confidentiality reasons. I just can't comment on any of it.
Any of it all? Could you maybe say that a percentage of it is yours or a majority of it?
No, I'm not gonna.
Not at all. Okay, I
comment.
understand. I appreciate your time. Thank you for doing this.
Awesome.
Yep, no problem.
Thanks, Labistro. All right, let me bring up Brandon, and then I'll get back to Alpha and Bortles. Brandon, I'm bringing you up. Just unmute and go right ahead. Brandon, you're up. All right. Cold feet. Bortles, let you go ahead. Your pup pick is nicer than Alpha's, so you can go before him. Yep, go ahead, Bortles. Bortles, you're unmuted, but I'm not hearing any audio from you. Okay, I'm going to add Alpha as speaker. And Bortles, once your audio is working, please go ahead. Alpha, you're up. Yes, sir.
Awesome. So I guess two questions. One, to the extent that you're comfortable with, could you just walk us through maybe some of your process and methodology, how it is that you came to look at Bed Bath & Beyond and maybe other special situations that you're thinking of? And then the second question being around the tail risk hedging you just mentioned, do you think it's actually feasible for a retail investor to run a tail hedging strategy?
I'll comment on the first question first. So to begin, I'd say one of the methodologies in which I did employ was first looking at sort of the general macroeconomic trends and seeing the to be fair, the first thing that caught my eye was the debt trading values, and then kind of looking at how debt kind of intersected with both baby and the company. I employed my own valuation measures of baby to kind of see where I felt that would be worth at, and that's both somewhat reflected within the letter as well as not. I think the letter kind of just says most likely above 400 million. The other thing that really did attract me to it was the capital structure as well as sort of the opportunity to do a realignment with it. I think having large shareholders and a management team in place that I think former board members being the CEO is not necessarily a bad thing. I think it's a good way to have an interim CEO. I'm not going to necessarily comment on where I think the exact value of Bed Bath and Beyond was, but when I was originally looking at it, I did feel that it would be undervalued at the time. And yeah, so that's kind of like how I kind of walked through it. And as for the tail risk hedge strategy, I will say, based on my research, there are ways to do it at a retail level. It is hard to do unless you have a portfolio of at least $40,000. But to be practical, you probably need to have a portfolio of about $160,000. Just simply how the option notional values would work. Obviously, if you were using if you're doing on a single stock, it could be better. I am aware of people using similar proprietary strategies on certain growth stocks, and that can certainly be used. I would say it probably would not work out very well on Bed Bath & Beyond simply due to the high implied volatilities there.
Makes a lot of sense. Thank you for that.
All right. Ian, I'm going to bring you up, and then Bortles, let's try that again. Ian, sir, the floor is yours.
Can you hear me?
Yes, sir.
Okay, great. Well, just one question. Given that you might become essentially a senior creditor to the business, and I only briefly looked at your proposal, and obviously haven't seen the prospectus for the bond. But I know you wanted to do a convertible, and the question that I have for you is: do you see more value in the business or in the real estate?
Bed Bath and Beyond, ultimately, as a result of one of their sale leaseback transactions, I think in 2020, does not have that much in terms of real estate. You were cutting out somewhat. I heard senior creditor, and what do you think is more valuable, real estate or I think I forgot what you said the second part was. If you could repeat that or
Sorry, the business or the real estate, like the real assets that the business owns.
Sure. For these purposes, I'll assume baby is not necessarily a real asset. It's not a tangible thing. I think that they do not have that much in terms of real assets. They have approximately $1 billion in property and equipment and $1.7 billion in inventory. But if you don't have a method to sell the inventory obviously is not as valuable. And then you also have on the property and equipment side, a lot of that ends up being leasehold improvements, which obviously aren't they are counted in the property and equipment for GAAP reasons. However, they aren't necessarily the best way to measure real value. So I would say probably the businesses overall would be the more valuable to me.
Great, thanks.
Thanks, Ian. Bortles, let's try this one more time.
Hi.
There we go.
Can you guys hear me okay? Cool. It just sounds like you're a student of the market. So I was curious if you were observing the events of January 2020 in GameStop and in the overall so-called meme basket. Do you see any similarities in Bed Bath & Beyond with the far out the money call options and the high open interest? And if you don't want to even bring it back to Bed Bath & Beyond, that's fine. I'd just be interested to hear your thoughts on the January 2020 events and if you agree with the SEC's conclusion that it was just retail pushing the price.
Sure. I haven't read the SEC report regarding that. I would say that at the time, at least, it did appear to me at least to be a short squeeze at the time. I was aware of the market happenings. I did discuss that contemporarily with other people. And I also, I think a little fun fact, I did actually attempt to publish an article on Seeking Alpha prior to January. I think it was either June or later that, September, regarding GameStop and GameStop's debt and potential for a short squeeze on that. But in general, I have not necessarily followed the meme stock craze too much. I will say in anticipation of this call, I did do some structural break tests, just simply comparing correlation of the constituents of a group of meme stocks that I saw was a representative sample. I will say, if you look at it around January of 2021, I did find that there to be a structural break, which implies that they were sort of trading together. However, on longer time horizons, the correlations appear to be comparable to companies of kind of more risky and growth kind of aspects. For example, Bed Bath & Beyond, GameStop, and AMC all would be considered somewhat distressed companies. Just simply, I mean, the debt does reflect that. That's not any way against management. I think that's ultimately potentially what you're seeing is kind of the intra high yield correlation and the effects of that on the equity.
Thank you very much.
Thank you, Bortles. Let me get to first question from Technotrades and bring you up, and then Iowa, I'll let you get on the question. And I do have a question line that I'm going to ask. Hopefully we haven't answered already, but Technotrades, please go ahead. You're on mute.
Hey, Jake, thank you very much for doing this.
Yep,
Do you
no problem.
do you find him inspiring in terms of activists, and then has he inspired you to be more involved in similar styles of investing? And then
Who are you? Sorry, you cut off on the first part. Who were you saying inspired me, or asking about if they inspired me?
He dropped down to listener. I don't want to put words in his mouth because I also didn't hear it. My assumption is Ryan Cohen, but let's see if we can circle back to that one. Turd Fong 23. Let me get to you since I was gone so far, and I'll get to Gafgarian, and then I will get back to you. Turd Fong, go ahead.
Hey, how's it going, Jake? How are you?
I'm doing well. I'm looking forward to your question.
Alrighty. So just 2 questions here. So one you may not be able to answer, but just going to ask anyway. So do you or any other affiliates of Freeman Capital hold any swap positions at all? And then second to that, so I read over obviously the proposal. So with the current market value, I believe you placed it in there $7 or $8 on BBBY. If you look at August and January, obviously there's significant open interest at the 10 strike. So obviously, if the company were to accept that market value of 7 to 8, those positions would obviously be underwater. Are you aware of that?
First off, the plan was not made in direct connection with the amount of open interest in any given position. I will say that I disagree with the notion that my plan puts a definitive value or market value on Bed Bath & Beyond. Even if the options are an 8 strike, it doesn't necessarily imply the market value is $8. In fact, for the general part of it, due to the high or the long time frames, it's likely that these options will not be exercised for a while, which means that they're most likely not going to be exercised, at least in the short term, unless the price receives kind of like the 20, 30 range. That's just pure speculation, just based off of the kind of empirical data that I've seen regarding just options in general. So I really disagree with the notion that it really sets the price at those points, and it certainly would have really no bearance on the shorter term movements of the market. As we get out 6 years, you could see that as definitely something that would weigh on the price. But I really disagree in the short term that it would have any real issue. And to address the first part of your question, within the basic definition of swaps, Freeman Capital does not own any credit default swaps, recovery swaps, digital default swaps.
Variance?
No variance swaps. Or if you want to go correlation swaps, none of the swaps I can think of. The reason why I just don't want to speculate on it purely is just simply swaps is a fairly undefined wording, and I don't want to say anything on that regard.
Okay. Thank you.
But if you have any questions on specific swaps, I can happily confirm or deny. Or no comment.
Thank you so much, Jake.
Alrighty, I'm going to interject. Technotrades DM'd me. Unfortunately, as we heard, the mic was garbled, but I got a question in line with what he was asking. So his question was for you, Jake, whether you were inspired by Ryan Cohen. I think you already answered the second half of the question, which was, do you plan on, well, maybe not. Do you plan on investing similarly in the future? Will you be engaging similar communities in the future? I know you talked a little bit about a future equity play and your interest in engaging with retail, but yeah, I guess were you inspired by Ryan Cohen and his investing style, and will you be engaging similar communities in the future?
I can't say that I necessarily was inspired by Ryan Cohen or his investing style. I'm not really going to comment on Ryan Cohen. It had really no bearance upon FCM's positioning, other than obviously the plans not interfering with any plans of any major activist shareholders. As for future stuff, I will say that I do plan on engaging some of the more retail communities. Essentially, a lot of times retail doesn't really have a voice in a lot of shareholder meetings, and simply driving voter participation to these annual shareholder meetings can help with some of the plans that I have in the future. They do not pertain to Bed Bath & Beyond. I have no intention, for the record, of engaging in any sort of shareholder proposal or proxy statement or proxy contest or any way influence or change the control of Bed Bath & Beyond, nor solicit anyone to do the same. Hopefully that was useful.
Yeah, and if they missed it, they can catch the recording. Just to reiterate, this is being recorded. It'll be available for replay up to 30 days on twitter.com. Gaff Garian, going to add you as speaker and get through a couple of other new questioners. In Iowa, I've still got you. I just want to make sure everyone can ask their question. Gaff Garian, please, sir, go ahead.
Hey guys, thanks for having me. I have two quick questions for you, Jake, and I appreciate you taking the time. First, as I'm sure you know, BBBY burning through cash, complete lack of liquidity is a serious issue, obviously motivation for your restructuring. Given the state of the current high yield market and recent downgrade to a Caa3 by, I believe, Moody's on the current bonds that exist for BBBY, why do you think that there are any bond investors willing to chance such a massive increase in debt for a company that already is sitting on significant debt and negative EBITDA?
Sure. So the first thing is the first part of the plan is really to help reduce that. It reduces it by around $600 million on the senior unsecured side by bringing it up. And I think investors, one of the reasons why, and I know it has gotten some flack from people both on this call and in Reddit and other forums, that these warrants and convertibility options are fairly generous, is simply to help entice these investors into doing it. For example, for the 2028 notes, the value of the options, when the kind of the dilutive effect of them, just having a lot of options out there, the value of the convertibility option is around $300 per every $1,000 you invest. So essentially, when you're a bondholder, you're immediately getting $300, which obviously helps reduce your stake. You're obviously not getting paid as much in interest, but your overall yield on it is around 11% when you consider the $300 immediately. Additionally, it's backed by, Bye Bye Baby, which I think for the most part, and I don't think it's in any way contradicting management, would probably be valued more than $350 million, which really ensures at least they get a $350 recovery on that front. They also get the $300 from the quote-unquote implied optionality value. And then additionally, as I kind of walked through early at the beginning, when you subtract out the $400 million from the ABL facility, you get an extra $400 million in the ABL facility. You basically have about $250 million in residual value from just the inventory side, assuming an average recovery rate on inventory. So that puts you in the 550 range. Additionally, the value of kind of the property and equipment, when you only look at kind of the real assets as that, and then you add in the cash, that kind of baby cash, which would be around $93 million, and some of the intangibles, you end up with an additional $600 million, which will help cover the $450 million remaining on the 2028 proposed notes. And that, obviously, there is a $200 million buffer there. And then, they are getting paid an 11% yield, so they shouldn't expect a perfect recovery. But in theory, then there's a remaining $200 million to distribute around the people who kind of take the proposed plan for the first part. Additionally, there'll be some, obviously, they're likely to file for Chapter 11, so there'll be some fulcrum effects on the equity side.
So just a quick follow-up to that. So I appreciate the thorough response there. So, with the state of the market and the fact that high yield markets are just not in use, right? Like even investment grade is tanking at this point and everything's going flat. So until we see, and obviously interest rate changes, things like that from Fed are not helping things. Until we see a significant turnaround with that, which could be 6 months to a year or more, like all type of high debt transactions are going to be largely not considered. So it's your thought that this is something that you're raising now in hopes that they touch it in the next year, or are you thinking or hoping that they move on this in the next 3 to 6 months?
I think the 3 to 6 month time frame is more likely with my expectations. Obviously, there is a very little issuance in the high yield debt market. However, there are a lot of funds out there which would always take a great deal, and I think this gives whoever takes the debt on, they do get very generous covenants, and that's kind of some of the reasons why. I mean, you look at Berkshire Hathaway, who had 8% yielding convertible preferred on Dow Chemical, or maybe it was DuPont. Obviously, during times of distress, companies have to give a premium in order to receive capital, but there are a lot of funds out there who would be willing to, or likely be willing to, take upon themselves to raise this money.
I wish you luck with that. I don't believe that's the case, but that's totally fine. And then the last question I have, I appreciate your time again, is you've said that you have an interest in engaging the Reddit community further on the future things, and that's fine. Like whatever you choose to do is I'm not going to dig into that. But I'm curious if you have any comments on direct registration of shares and the community belief that there is a value in retail investor lockup impacting liquidity or in any way reducing share lending opportunities.
I don't think I'm going to comment on that. Just I will say the cost that people have been associating with computer share, potentially, or AST in this case, charging money to Bed Bath & Beyond for increased registered shareholder fees is unlikely to be important. That's the only comment I'll really give. It won't really affect Bed Bath & Beyond from people registering in terms of costs.
Yeah, but no comment on on potential liquidity impact of share lockups and retail investments versus institutional lending.
I will say it would definitely decrease liquidity if people lock up enough shares. I mean, I think the point this community wants is to, I'm not saying they want to reduce liquidity, but it certainly would reduce liquidity.
Enough to make a difference, you think?
I have not done enough analysis on the marginal from a volumetric standpoint, so I really can't give an informed opinion on that.
All right. I appreciate your time. I'll step down. Thanks, guys.
Thanks, Gash. Okay, Tendy Man, you are up next, and Iowa. Then I've got you queued next.
Hello.
Howdy.
Hi. I have a question for Jake. I'm reading this document that you produced. It's called Analysis of Dilutive Power of Warrants. And I'm wondering, you're presenting this minimization problem where you have this function it's a function of the implied volatility in this quantity called Q. And I'm wondering if you actually performed a Graham or a Garch model to calculate the strike price, ideal strike price of these warrants that would minimize dilution.
Yes. So essentially, I've had a lot of experience using the Garum model. I did not use the Garch model in this case, just meant to be more general, kind of back of the envelope kind of explanation. But essentially, using those models, you're able to get a very good understanding of what is happening, both for the buyer of the warrant, in this case, it would be the person who gets the warrant issued to them, as well as the underlying dynamics as it reflects to the jump that is alluded to in the practical case part. And both of those had important impacts on ultimately where I decided to choose for the strikes in the paper or the letter. Certainly a lot of thought, effort, and energies were put into figuring out where would be the best for it, both from a sense of what would the theoretical yield need to be for a bondholder to be enticed to do this, as well as sort of what strike prices and timeframes would be most advantageous to kind of work within that framework that you're mentioning.
Oh, thank you.
All right, thanks, Tendy Man. Let me bring on up Iowa, and then I see Daniel. I'll get to you next, sir. Iowa, please go ahead.
So what are your thoughts on, the last 2 quarters that Bed Bath & Beyond presented were pretty much crap, losing a lot of money in the last quarter especially. But, when your plan for getting access to liquidity, obviously it's great to have extra cash, and having an extra $1 billion helps. But with as fast as they were losing money, how do you feel about them trying to move forward, essentially with the starting plan being in the form of what Mark Triton had done for Bed Bath & Beyond, which seems to not be working? Do you feel that $1 billion is really going to get them to that next level to be able to transition into a profitable company? And what are your thoughts on Bed Bath & Beyond having more focus on just being an online business, and maybe restructuring some of their stores and actually becoming more of a Bye Baby dominant retailer?
Sure. So to kind of address what you're stating, first off, I think that having a retail presence is certainly something that I don't think is going to go away per se for Bed Bath & Beyond. I think the strategic plan of the board kind of is for close some of the more unprofitable locations, but not necessarily all the locations. I think that the Bye Baby side, obviously, given the fact that they're growing the amount of locations retail, I think there's certainly a larger case for the retail on that. I mean, if let's say you need something really quick for your baby, various things, they don't stop crying, or they do general baby-like activities that require going to the store, it's obviously better if you can just run somewhere specialized. And that obviously would be advantageous. Obviously, I can't comment directly on my thoughts regarding the former CEO of Bed Bath & Beyond. I would say, though, that I think $1 billion would probably not be sufficient to fully execute upon the board's turnaround vision. I think, though, this is one of those things where it might be able to take them into 2025, where financial conditions obviously would be better. One of the previous speakers was commenting how hard it would be to raise the bond issue itself. I think that's, given the generous terms on it, I think speaks highly towards how it would be hard for them to raise any liquidity in this environment. And I think really speaks to the fact that if they do not go through a debt or equity offering, their real only solution would be to fire sale some of their potential key assets. And I wouldn't want to put any words in the board's mouth, but I think really that's where we are in terms of where it is. And I think while it might not be enough, I think it's the practical reality of the situation.
And what are your thoughts about the company selling itself now? Do you have an opinion on stock price? So you'd be willing to, do you think that they have the option to be able to sell themselves so somebody private could actually have more time to be able to resolve these issues?
I think that I'm obviously not going to comment on what I think was the right stock price. I will comment, however, that I think so right now the bonds that have been issued, I'm not sure on the ABL facility, but I know for a fact on the notes that have been issued was basically when a change of control, such as a sale, merger, those sorts of things occurs, the person would have to buy out all the debt. So potentially one of the things, if Bed Bath & Beyond decides to go forward with the first part of the plan, would be that it would make the company more marketable from that standpoint. Obviously, secured debt tends to be better off in terms of a covenants and allowing for companies to kind of not have to buy out the debt. So I think that ultimately the first part of the plan would be very advantageous towards a sale. I think the real hardship with the sale is it's not that you have to pay the $400 million or whatever the price someone pays. Just $400 million is the current-ish market cap. I'm not saying that's where I would accept or anything like that. Essentially, it's about the debt and the $1.2 billion that to pay immediately for that. So I think that's kind of the hindrance to any potential acquisition.
Great. And this is more of a statement, but my hope is that maybe we get down the road and Bed Bath & Beyond decides to become maybe 150, 250 store footprint where it works, and then essentially just transitions their other stores to a buy baby model, which seems to be a winning model instead of trying to figure out how to make a dying, what appears to be a dying brand work. They have way too much competition with the bigger players, and I mean, why fight it? Why not just recognize that you have a great brand and move forward with the one that works?
Sure. I think ultimately the point of my proposals is simply to give the board the room that it needs to excel and figure out how to make the company profitable. There obviously is some value to the Bed Bath & Beyond brand as itself. There is value for the Bye Bye Baby brand by itself as well. And I think it's about giving the board the opportunity to really maximize both of them. I do actually think, on kind of with a little bit of retrospect on my previous statement about the $1 billion, I think the $1 billion could be enough that the board does execute upon it. Obviously, there's always headwinds that can occur. So that's where I was kind of getting at with that statement. I do, however, believe and have faith in the board to eventually determine kind of and find the optimal path. And I think obviously there's a lot of factors here that we can only speculate on that are challenging Bed Bath & Beyond. And I think none of us really have as good a grasp on them as potentially management does. I think management just should implement this plan simply because they might have been distracted. That's why I think they have to do something similar to this. And I simply am just putting forward something I think could be helpful.
To your ownership of 6.21% and then owning call options, is your goal to be a long-term investor or a short-term investor in this?
I will not comment on the time horizon of the beneficial ownership disclosed in the 13G.
Yeah, that's understandable. Do you ever see if this doesn't work out where you might transition to becoming an activist investor, or do you think you'd be done and let Ryan Cohen essentially take the lead?
I have zero intentions in being an activist shareholder for Bed Bath & Beyond. I think in the coming weeks, you will see a certain activist play occurring with myself and a group of others, which will be unaccompanied. I'm not going to disclose which, but I will say that activism isn't necessarily something I'm against. It's just something I don't think is right for Bed Bath & Beyond. There is a phrase, too many cooks in a kitchen.
Understandable. One last question. Do you think that you would be willing at any point to increase your position and Bed Bath & beyond what you'd receive through the calls?
I'm not going to comment on that.
Understandable. Okay. I appreciate you answering all my questions.
Thanks, Iowa. Alrighty, let me bring up Daniel. And while Daniel comes up, I just had to make a comment. I really enjoyed the performing baby-like activities. That was that was a good one. All right, Daniel, please, you're up. Go ahead, sir.
All right, I just have a couple questions. My first one is, does FCM or any of its affiliates own any total return swaps? I noticed that was something you didn't say earlier on.
No total return swaps.
Okay. My next question is, given your age and the employment at 14 by Vivek and Polaris Capital Management, one would assume that you had family connections. Was either of your parents employed or grandparents at a fund or a Wall Street company?
Neither of my parents worked in finance. My dad does work in finance adjacent field. However, that had no bearing upon my ability to receive the job at the firm in which you referenced.
And my last question was, how much did Vivek pay you to hold his bag?
I'm not sure what the quote bag that you are referring to is, but I will state for the record that none of
he dropped, by the way.
None of the stakeholders of any firm in which I have previously been gainfully employed at are investors in this fund.
All right, I don't have anyone else queued up. If there are any other questions, giving it a 20-minute warning, though. If there are more questions, we're going to wrap by 6 regardless. I do have one Jake, this was from the GMEDD Discord, from Crypto Zingus. He asked it this morning, and I think you might have replied to him. It's a three-part question, so I'm going to go part by part. First part is, have you considered lien/secured debt capacity for your proposed exchange? And does Bed Bath have the $1 billion of lien capacity to secure the convert? That's the first part of the question.
Sure. I actually, when I was structuring my prepared remarks, did take that into consideration, but I'll reiterate what I was saying earlier. They have about 2.7 billion in kind of lienable assets. I'm not sure if that's necessarily a word, but I guess you guys can quote me on that one. Essentially, of that, you have to consider certain liquidation preferences and kind of how they would get liquidated in bankruptcy. But it's likely that they would have sufficient lien capacity. I think if you look at their ABL facility and kind of the terms of that has, and you'll see that the banks that have backed the ABL facility do believe that there is a significant lien capacity beyond 1.6 million. So essentially, that's what I would say in terms of the lien capacity.
Okay. You probably then addressed the entirety of the question in your prepared remarks. If you're familiar with the question line that I'm going down, so I don't want to make you repeat yourself. If you already answered this and it just went over my head.
Yeah, I mean, if necessary, I can still readdress it. I think it's definitely something. It's definitely one of the questions that I've had that people, in terms of the institutional investors that I've talked to, have been definitely kind of concerned about. So I just pulled it up on my end to kind of talk about the credit docs and as the parents and subs. To answer that question, basically the whole thing is kind of subordinate to the ABL facility. So it's kind of structured around kind of where the ABL facility is, and essentially the senior unsecured notes were issued at a time when Bed Bath & Beyond was in a better position financially, and their covenants are not very strong, to kind of just be blunt. I'm not really sure what the second part's really asking. And then the third part is talking about the participation, which I think I did already address. And also, again, if there is the extra billion or 1.4 billion senior liens above you, it still would be likely people would be willing to switch, just simply because it makes recovery even more unlikely. So being ahead of the larger unsecured pool would give you a higher recovery. And then the supra senior thing is depending on interpretations of the credit documents. I think they were issued in 2024 or 2027 or 2014 or 2017. There is kind of, it's not very aggressive where you could make the argument that they're for a supra senior status. Obviously, that's something that ideally would never be challenged, as ideally it would go before a judge to figure that out, and that would likely only occur in the event of bankruptcy and really would not be material to the stakeholders for BBY. I think ultimately there's sufficient covenants on the 2024s that the supra senior status can be kind of taken away and it would still be fine. I guess that's the entire
Perfect. Address. Got a couple more. Got Value Rich, going to add you. Alpha, looks like you're going to come back for a third round, and I'll let Jake kind of close out if there are no further questions at that point. And Value, please go right ahead.
Hey, Jake. Yeah, my question's a little less on debt, more on qualitative cash flows. I mean, there's some underlying trends going on with Bed Bath Beyond, changing wedding registry, some COVID specific stuff. I'm curious to get your take on the cash flow side. Like, there's a runway, how long they have that runway, but there's also a normalizing for a lot of underlying trends that are going on right now. I'm curious to get your basic qualitative approach.
Sure. I think there's, as you mentioned, there are a lot of runway trends. Or not runway trends, a lot of trends that Bed Bath & Beyond is exposed to. I think I addressed the runway question earlier, but to kind of focus more on the trends, I don't see any of those trends having any meaningful kind of change over the next sort of 1.5 to 2 year time frame. Yeah, they definitely could start having some effects as we kind of approach the 2028 timeframe. I think ultimately it would be in a positive manner for Bed Bath & Beyond. I think Bed Bath & Beyond is very well positioned itself for a lot of the trends that you mentioned. Obviously, I can't speak to what management is planning to do to kind of capitalize on its positioning. So depending on execution, it could definitely be very well, but I don't foresee any of the trends being an issue or a headwind, so to speak.
Gotcha. And a follow up on that is, as you think about the, I understand there's some legalities about expressing your valuation here, but as you think about having put a proposal out there, that, hey, maybe they'll snag something similar to it or not, but to put substantial amount of money towards it without certainty, I'm curious how you think about that against their cash flow burn.
Look, I trust that management will do something to solve the liquidity problem. Obviously, I'm biased in the fact that I do believe that my proposed solution does provide a very effective way to solve the problem. Obviously, there are a lot of factors endogenous to Bed Bath & Beyond that I probably have not considered, just simply because I don't have access to all the data that they would have. But I do have faith in management's ability to kind of solve the short-term headway in one way or another. Obviously, as I mentioned, I am somewhat biased in how I think they should do it, but ultimately I have confidence that they would do something similar, potentially. I mean, I think similar idea. They might do a different execution, but I think generally in the consensus I did when I was talking to some institutional investors has really been that they need to do something similar to this. So I don't think it's anything that they don't know they need to do. I'm just more proposing a outline of exactly what I think would be the best for it. And obviously I put a lot of time and effort into kind of figuring out what that would be. And I do hope that they consider it. Obviously, if they don't, that's okay too.
Appreciate it.
All right, thank you, Value Rich. Let me bring Alpha up, then he can close the loop on this before we wrap.
Again, so I know the quality of some of the questions on this call have been all over the place, and there's some really good ones, and it seems like the retail community has also perhaps been a little polarized by your proposal. And I was curious, I guess, was that something that you were expecting, or is that a little unexpected? And does it have any material impact on the way that you're considering sharing your theses in the future?
I definitely was not expecting such, I guess, visceral responses and strongly opinionated responses from the Reddit community. Obviously, I expected responses on the institutional side. I was somewhat shocked by sort of how, I guess, large the response was on the Reddit community side. And I'm sorry, I forgot the second part of your question.
Will it impact your thinking going forward, sharing theses publicly?
I think that overall you have to be careful of where you share things, but I think engaging the Reddit community for already shared theses that are already disclosed is definitely something important, especially with companies that have very high percentage owned by retail. Obviously, Bed Bath & Beyond is a fairly institutionally owned company, but I think there's a lot of companies out there that I've been looking at that certainly are not owned heavily by institutions and are more retail based. And I think engaging in what I guess I would call like the quintessential retail shareholding group would definitely be important, and their opinion definitely matters, especially as it relates to proxy statements and proxy wars, which are not going to occur in Bed Bath & Beyond, but in general.
Thanks for sharing. And I guess the third question, and my apologies because I missed the intro to this call, but how is it that you and Rod came to put this together and got hooked up in the first place?
Sure. I was, I guess, as people have said, quote, lurking on the Reddits when this was initially announced. And I saw this server mentioned, and I was like, oh, let me check it out. And I scrolled up through the Discord and kind of looked at what everyone was saying. And I guess I ultimately deleted it almost immediately after posting it. But I was somewhat shocked at kind of people kind of reaching out to acquaintances of mine and friends of mine and kind of just them asking for comment. And ultimately, you know, in a kind of a little bit of a moment, I unadvisedly kind of asked for it to stop. And that's kind of how I first interacted with the server.
If anyone's being a jerk, let me know and I'll give them the boot. Gaff, I've got you back up. Got one other person trying to squeeze a question in as well behind you. We do have 9 minutes till the promised end time, so let's try to squeeze these in and then wrap.
Yeah, I appreciate that. I'll make it quick. So I just wanted to come back and kind of address the first question I asked about the possibility of bond investment in the space, and just to clarify, like the reason for that discussion point. You know, if we look at just bond issuance and high yield over the last like 5 years, 2018's 4, 2019 in specifically consumer discretionary retail sector or retail subsector. 2018's 4, 2019's 4, 2020, 17, 2021, 18. Obviously, the reason for that is because COVID completely tanked the retail market, and then everyone was able to take out significantly lower loans when interest rates were still low. The state of the market at the moment has given two. So only two in the last trailing in 2022 alone for the consumer discretionary retail subsector. The only one of those, only one in the last out of the last 8, I believe, is over $1 billion, and that's to Carvana, which is this year 3.275. But obviously, Carvana is sitting on a massive amount of assets, right? So that makes sense. So I guess the question that leads to that is, in the event that you say that there is interest in this, that you believe that there is interest in this, at what point, if you get no response from the board on this, and they don't move on this because they look at the same numbers that I see and see that there is no interest, or they don't believe there's interest, at what point do you just make the assumption that they aren't moving on it? And if they choose to not move on that, I know that you said that you aren't going, it's not going to impact your holdings, but do you submit more letters? Do you submit ultimatums? Any thoughts on that, or is it basically just if there's nothing comes from this, then you'll just continue holding and see what happens in the long play?
I have no plans to issue any ultimatums to the board. I obviously would hope for, if the board would engage, at least kind of discuss it. That would obviously be best. However, potentially I might write letters. I'm not sure if it would be in the same public format. I do obviously disagree with you on the debt issuance, and I think that the numbers there obviously are important, and they do reflect industry trends, but I don't think they necessarily reflect any individual company's ability to raise capital. I think one of the important things to note is during 2008, 2009, when there was a significant decrease in a lot of bond issuance, but you actually saw a lot of companies doing private placement deals, and that's kind of some of the reasons why you saw some of those declines in the numbers. It's a little too early to kind of see the bearing on that on this current kind of decrease in issuance of debt, but you certainly saw that happen during 2008, 2009, and I do think that if there isn't necessarily a market opportunity for this, there certainly would be a private placement opportunity. There's certainly a lot of debt-based hedge funds that were highly capitalized and very much in cash prior to the sort of, I guess, market downturn this past year. And I certainly see them deploying a lot of that capital, and I think that will be in the form of potentially private placement, but also potentially a market issue.
All right. Good. Well, good. Again, good luck. Thank you for your time. I appreciate it.
All right. right, thanks, Gaff. Last one then, it's 5:54, so I'm going to let Expression as a Virtue ask the last question, and then we're going to wrap.
Hi. Just real quick on kind of like high-level modeling assumptions on bankruptcy. Just because the terms of the restructuring seem very aggressive, and it almost seems like it is presenting BBY that it's going to go bankrupt within the next 6 to 12 months. And so here's this offer. But at least for me, when I look at the balance sheet, they have a lot of current assets to keep going and to serve as collateral. A lot of the restructuring charges that they've incurred over the past few years aren't going to show up this year. And now they're going to start to reap the benefits of a lot of the investments that they've been making. And so I think in the media and also the way that the debt restructuring presents the company is as though bankruptcy is inevitable for the company, and so they have to issue capital or do something, which I just don't think is true. But in your sense, like, I guess one, do you think that bankruptcy is an inevitable thing? Is that something that you modeled in regardless of what kind of restructuring you propose? And then I guess number two would be like, is the step two, like, I guess how long of a timeline are you giving this offer to just kind of be out there? Is it going to be like an extra month or 2 months and then you guys might propose something else? Not sure if you can share that, but anything would be much appreciated.
Sure. So to address your second part first, there is no timeline per se. I think that the board, certainly based off of what my understanding is from analysts, is the board definitely understands that there is a financial risks here and that they do need to do something about it. Obviously, I don't want to put any words in the board or influence their actions, but you addressed that they had a lot of current assets. I'm looking at their balance sheet right now. They have about $107 million in cash. If we kind of look at that depending on the quarter, they've had a higher than that cash burn. I actually don't recall any quarter where they had a lot less than that, so it's about a quarter there. Additionally, that they have about $8 billion in merchandise inventories. Obviously, that isn't cash, and there's a lot of cash expenses that Bed Bath & Beyond does incur, and sort of the reason for these proposals is to help capitalize on the inventories to kind of give them some more runway. I certainly think there's a serious liquidity issue, and if they don't solve it, there certainly is a risk to bankruptcy in the next 6 to 12 months. I hope that doesn't happen. I think the plan helps kind of avoid that, and as sort of kind of your comments are kind of juxtaposed between the person who kind of came before you, it is hard to issue debt in this environment or even do tender offers in this environment, and I certainly think that the person kind of came before you kind of was maybe a little too aggressive on that front, but I also don't think should be understated. There's certainly, you have to give a fairly generous offer in terms of terms to get financing, and that's just kind of the way that the market is right now. And if the board can come out of the way that they kind of has to raise less capital, that would be amazing. They are not less capital, less dilutive effects. That would be a great thing. I think capital is really something that's scarce right now, and as a result, you have to give fairly generous terms to investors to entice them.
Dope. Thank you.
All right. Very good. Well, let me briefly just say thank you, everybody who participated in this. Jake, thank you for reaching out and for us being able to make this happen. I hope that if there are opportunities in the future to have this sort of a discussion on different equities, that this is kind of core to Wook Capital's thesis, is that holding open conversations of this nature really is advantageous to everybody. Like you were noting, institutions typically have higher levels of access, and giving retail ability to get that sort of access is helpful and constructive, and something that I think we are in alignment of that thinking. Jake, it's been a pleasure to kind of co-host this presentation with you. Really appreciate everybody asking the thoughtful questions that we did go through. The recording will be available, as I said, for 30 days. This link through this link here. And Jake, if you want to close it out with your final comments.
Sure. I think it was definitely great to answer all your questions. Certainly, yeah, there's a lot of amazing questions in the mix. I certainly think that a subset of the Reddit space, I guess the meme investor, I'm not sure the exact terminology for it, but has certainly presented a lot of constructive criticisms and critiques that I've definitely had to give thought about. I certainly have given a lot of thought to the warrant problem, and even looking at kind of back of the envelope right now, various ways in which the kind of dilutive effect, if there's an event of a serious pop, could be sort of removed from the warrant equation, and obviously kind of figuring out where that kind of lies. And I think that it's really helpful to kind of engage with a more diverse set of people. Obviously, institutions are fairly open-minded, but they do tend to be a little dogmatic as well. And I do think it's important that everyone gets a chance to kind of discuss these things and not just hear what analysts say on a call, but also, discuss them with their own questions. There obviously is a lot of different questions, and I think the high levels of activity on the r/BBY subreddit really speaks to that. And I'm really happy that everyone decided to come out and hear me speak. I'm certainly glad that a lot of people had questions, and I hope I did my best to answer them. Thank you.
Thanks, Jake. Thanks, everybody. Hope everyone has a great evening. Take care.